Hello everybody, welcome back to another valuation investing video, and today I'm going to be looking at 3 stocks that are near 52-week lows that I believe are a good buy today. The reason I like to look at companies near 52-week lows, that normally brings up a good buying opportunity to buy a company at a low price. You want to buy stocks that are on sale and at a lower price. So today in this video, I'm going to be going over 3 companies I think are worth a buy that are near 52-week lows. And I'm going to be going over the financial health of the company. And each company, I'm going to be using an intrinsic value calculator that will calculate what I believe each company is worth and what their stock price should be at. The first stock that is near a 52-week low that I think is a buy is Microsoft. Microsoft as of today is at about $411 per share, and its 52-week low is $385. So it is pretty close to the 52-week low. As most of y'all know, Microsoft is an American multinational technology company that develops and sells software, services, and hardware. And some of their products include Windows, Microsoft Office, Xbox, and Azure. If we look at my 7-step stock analysis for Microsoft, we can see they got 6 out of the 7 metrics that I look at. So first off, their PE ratio was above 0 and it's at 33.02. So that has a check mark and shows they are profitable. The only X Microsoft got was a forward PE ratio less than 30. They were just barely above that metric and they were at 31.15. So Microsoft right now, the stock could be a little bit rich in price. But if we look at the revenue growth rate, it is at 15.2% over the past 5 years, which is triple what we want in 5%. And then the EPS growth is doing even better than the revenue growth at 19.5%, which is also a very good check mark and just very fast growth, which you like to see in companies you own. Then we look at the shares outstanding. They have been decreasing shares pretty slowly. However, it is decreasing at about a negative 1% rate. Debt to equity ratio is at 33.66%. So they have triple the amount of equity as they do debt. So that looks pretty good. It's probably unlikely for them to go bankrupt. And the final metric is the expected EPS growth rate. Analysts are expecting Microsoft to grow at about 14.4% rate. And that is greater than our 5% we want. So overall, Microsoft looks pretty good. 6 out of 7. So that's pretty good on our 7-step stock analysis. So with the first stock, Microsoft, I have to use assumptions that I believe in the future that these companies can do. So the first thing I have to estimate is the revenue growth rate over the next 10 years. And I think over the next 10 years that Microsoft can do a 14% revenue growth. Also, analysts do believe that Microsoft can grow at this rate. So I'm going to put this at 14%. So now we have to look at the net profit margin. I'm going to put a 35% net profit margin because if we look back at the net profit margin on average, for the past 5 years, it's been basically right at that 35% mark. For the cash conversion rate, we can leave that at 100%. And for the terminal PE ratio in the next 10 years, I'm going to put this at 22. And the reason for that is because I believe Microsoft should deserve a premium with their high revenue growth rate and pretty big moat. So then finally, a discount rate, I'm going to leave that at 12% for a margin of safety. And as we can see here, I have a fair value price for Microsoft at $457 per share. And if you were to buy today at $412, you would make approximately 13% year over year on Microsoft. The next stock that is near a 52-week low is Adobe. Adobe's stock as of today is up almost 5%. However, it is still near a 52-week low. The 52-week low is at $403.75, and right now it's at about $451 per share. So it's pretty close to its 52-week low. And most people probably do know Adobe, especially Photoshop, but Adobe is an American software company that creates programs for digital media and marketing. Some of their products are Adobe Creative Cloud, Adobe Document Cloud, Adobe Experience Cloud, and Adobe Acrobat. Now if we look at Adobe's 7-step stock analysis with my metrics, we can see they got 7 out of 7, so this looks pretty good for Adobe stock. And as we can see here, their PE ratio is greater than 0, meaning the company is profitable. The forward PE ratio is pretty low compared to the PE ratio, so that looks pretty good, meaning that earnings per share is likely to grow pretty fast, and that is at 21, so for the future, it looks pretty good valuation. Then if we look at the revenue growth rate, over the past 5 years, they've grown at about a 14% rate, which is greater than the 5% rate. And also the EPS growth rate is at 16.5%, so both double digits, pretty good growth. And for the shares outstanding, they are actually decreasing their shares by 2%, so they are having buybacks. With these buybacks, that means the company will not be diluting us shareholders. Now at the debt to equity ratio, it is less than 100% at a 41.79%. While it's not amazing, it is still pretty good, meaning they have just over double the amount of equity compared to debt, so that's good. Then finally, the expected EPS growth by analysts, they expect them to grow at a 12.4% rate, and we want that over than 5%, so it looks pretty good for Adobe. Now if we head over to the intrinsic value calculator for Adobe, I'm going to put a revenue growth rate for the next 10 years at 12%. The reason I'm going to put this at 12% is because analysts expect about a 12 to 13% rate. So now for the net profit margin. As we can see, it's been about 26 to 30%. So I'm going to put that in the middle at 28% net profit margin in the next 10 years. And now for the PE ratio, I'm going to put this at 23 because I think that Adobe deserves this premium also compared to the market since they're going to grow at a faster rate. And put the discount rate at 12%, and as we can see here, I have a fair value price of $441 per share. And as of today, it is at $451 per share. So it's pretty much right at the fair value price, and I think if you bought it today, you'd get an 11.7% return. If you believe these assumptions are true, I think Adobe's a pretty good buy. Now the final stock that is near 52-week low is probably one most haven't heard of, and I am very tempted to buy this company, and this is Elevance Health. Right now they're at $395 per share, and their 52-week low is $362. So it's basically near the 52-week low. I think it's the closest to the 52-week low of the other two companies. This could be a good price to buy it. And Elevance Health is a health insurance provider that offers health plans for pharmacy services and specialty insurance. And if we look at the Elevance 7-step stock analysis with my metrics, we can see they also got 7 out of 7, similar to Adobe. And for the PE ratio, it is at 15.24, meaning it is a profitable company, so that's good. Forward PE ratio is super low, which means you aren't going to be paying as much for a dollar of earnings compared to, say, Microsoft and Adobe. So that also looks very good. So now if we look at the revenue growth rate, it's also pretty good. Although it's lower than the other two, it's at 13% for an insurance company. That's pretty high. And the EPS growth is at 11.3%. So that's a bit lower than revenue growth. I don't really like when the EPS is less than the revenue growth. That either means that they're increasing shares or their profit margin is decreasing. So that's not looking amazing, but if we look at the shares outstanding, that is decreasing at about 2%. So I'm guessing the margins have been coming down slightly, so that's not a very good sign. But the debt to equity ratio is the highest so far at a 61.87. However, it is still less than 100%, so that is good once again. A little less than double the amount of equity than debt, so it still looks pretty good and unlikely for them to go bankrupt. For the final metric of Elevance, expected EPS growth, they're expected to grow at a 9.8% rate over the next 5 years, which is greater than 5% and is a check mark. Now for the final stock, Elevance Health, I'm going to use my intrinsic value calculator once again to determine what price I think we should pay for Elevance. So for revenue growth rate, they're expected to grow at about a 10% rate over the next 10 years. I'm going to put this at 9% to be on the safe side. Now for net profit margin, as we can see, it's been very consistent at 4%. So I'm going to put this at 4% for the next 10 years because it has been so consistent, I think it can still stay there. Now for the terminal PE ratio. I'm going to put this at a 17 PE ratio because I think it can grow about the rate of the stock market. So I think 17 PE ratio looks pretty decent. Now for the discount rate, 12% once again. And as we can see here, a fair value price of $644 per share. So if you bought this today, you'd probably make a 19% return if these assumptions came true. If you do think these assumptions can become true, I think this is a great buying opportunity for Elevance Health. However, I would be a little bit worried since it is a health insurance company. Thank you guys for watching this video. Hopefully you liked the video. Please leave a like and comment. See ya.